Welcome to the Lend Academy podcast, session number 41. This is your host, Peter Renton, founder of Lend Academy. We have a very special guest on today's program. Karen Mills is someone who has been a champion for small business her entire career. She's most well known as the head of the Small Business Administration from 2009 through the end of 2013. And she was appointed by President Obama during what must be seen as one of the most challenging times for small business in many decades. And she really did a lot to really help small business lending, help small businesses in general as the head of the SBA. So I wanted to get her on the program to talk about, the role of government, the role of regulation, and where she sees, small business lending when it comes to the online platforms, where she sees this going, and what are some of the opportunities and risks for the sector. I hope you enjoy the show. Welcome to the podcast, Karen.
Delightful to be talking to you today.
Okay, great. So I want to get started by getting a little bit of background about yourself. Can you tell us a bit about your career before you joined the Obama administration and the Small Business Administration, and what you did before then?
Well, before I went to Washington, I actually had a long career in the private sector in leveraged buyouts and venture capital, about 25 years, starting in 1983, before there really even was leveraged buyouts. Mm-hmm. And at that point, we bought a number of manufacturing companies. So I bought plastic injection molders, automotive suppliers, makers of electronics and subfractional motors all across the country. And that gave me a real sense for how the American economy works and what it was like to sit in the control seat of a manufacturing company, particularly in terms of getting the right financing for that company, whether it be bank debt or equity, and how to navigate the ups and downs of the economy. I actually ran a number of those companies through the recession in 1989, 90, and 91. Mm-hmm. So that really gave me a sense for how we create jobs in this country and the role that small and medium-sized businesses play.
So then was it your choice, was your ambition to join the public sector, or is it just kind of fall into your lap?
Well, I never thought at all about becoming part of the public sector, but in the early 2001, my husband took a job as the president of Bowdoin College, and we moved to Maine. And I got very involved with the governor of Maine in redeveloping the Brunswick Naval Air Station, which had gone on the BRAC closure list. The base was closing. It was right in my town. And the governor said, well, you're a venture capitalist. You probably can create some jobs and start some companies, and we're going to need them. This is your community. You have to help. So I got involved with that, and we created a cluster of the Maine boat builders and the composite technology sector. It turns out that there was tremendous innovation in faster and lighter composite boat hulls, and we created an opportunity for all of the small and medium-sized independent boat makers to come together. And that was really a lesson I took with me into Washington and into the Small Business Administration, that as you grow an economy and create jobs in this next century, we can't rely on big companies, especially in rural states like Maine, to come in and really be the generators. We have to look for innovation, and then we have to create mechanisms for these small and medium-sized companies to come together and get the scale that they need to get skilled workers, to get capital. So when I was doing that, I ended up writing a paper for Brookings and ended up on the transition team for the Obama administration. And then somebody said to me, well, how would you like to do this job? And I said, well, I'd like to do it. And so we have to have an interview. So I had an interview with the president. We got along, and I was able to have the great honor of serving for about 5 years in his cabinet and as head of the SBA.
Mm-hmm. And so let's just talk about that for a bit, because, I mean, you arrived at the SBA in probably the most difficult circumstances of the last 75 years, or since the SBA was founded, I imagine. And so you came in at a time when banks weren't lending, layoffs were happening left, right, and center. Can you just talk a little bit about that time and what some of the things that you did immediately to try and help small businesses?
The president appointed me in December 2008, and I think we forget today how difficult it was in that period of time for the whole economy, but particularly for small businesses. The credit markets were absolutely frozen. Banks were not lending at all. And I realized that we had to do something quite bold. So I was able to persuade the rest of the White House economic team that we should raise our SBA guarantees to 90% and eliminate all the fees on SBA loans. And I call it the hockey stick that did happen, because it really worked. Mm-hmm. But it took some persuading because people were concerned that we would get all the bad loans. Well, as it turns out, we got better and better credits because the marketplace was just unavailable to small businesses, and great small businesses were having their credit lines pulled.
Yeah.
So we were really able to turn that around, and we ended up having record years. $30 billion of loans were facilitated by SBA guarantees into the hands of small businesses in those years, and Congress came back and replenished our funds for doing this 5 different times, even in that difficult environment. So it proved to me that if you were tenacious and you understood the facts behind the problem, and you could prove that this was going to be critical to an important part of the economy, you could really get something done.
Mm-hmm. Mm-hmm. Yep, for sure. So I'm sure that there's so many stories of that time where people with multi-decade relationships with their banks, with the credit lines that have been established for a long time and successfully being payments being made, and suddenly the rug was pulled out from under them, and it certainly did need some bold action. I actually went back and watched your lender presentation a few days ago, and one of the things you said there, which struck me, is that you talked about the amount of small business loans being held on bank balance sheets. So you talked about that they've fallen by 18% since the high, which was in 2008, and they really haven't recovered. So what are the reasons that it's remained flat or even declined while we're having this, this recovery?
Well, after I left the Obama administration, I came to Harvard Business School and had the opportunity to step back and really take a look at the data and analyze the situation on small business credit. And there was, and perhaps still is, a big argument going on in the recovery as to whether there is a gap in small business credit. And the reason that there's a big argument is that we actually don't have the right data. In Dodd-Frank, there is a provision for banks to collect that data, but it has not yet been implemented. And the data you would want is loan originations by size of loan or by size of company. So all we have now are the assets of loans under $1 million that are on bank balance sheets. And it's a proxy for whether or not there are lots of small business loans out there. And in fact, that number shows a disturbing trend, which is that it peaked and then in 2007-ish, and then declined abruptly, of course, during the recession by 18% and has not recovered. So it was up around $700 billion. It's down to about $600 billion, and it has been flat even as things have been improving in the credit environment and in small business optimism. So that is one indication that the volume is not out there of small business loans that might have been out there in the past.
Mm-hmm. Yeah, no, that makes sense. So, and also along with that, there's a disconnect, it seems, with what banks want to provide and what small businesses want. And it was talked about in many sessions at Lend It. And it was also, you mentioned it in your presentation. And you actually gave this great graphic about the $250,000 loan market and below is what small businesses want. And it's the exact opposite of what banks want to provide. So do you think the banks are basically giving up on that market and they're going to cede it to these more innovative online lenders, or do you think there really is a drive in some banks to keep lending small amounts to small businesses?
Well, as you mentioned, there really, it turns out, is a gap in the small dollar loans. We looked at all kinds of data about the credit gap and found that under 250,000, maybe 150,000, that is a very difficult area for banks to lend. Why? Because they would much prefer to do a $1 million loan. It costs the same amount to do the underwriting as for a $100,000 loan, and there's much more profit in it. And I actually went through the economics with a number of banks who showed me that it was unprofitable for them to make those smaller loans. That was one of the reasons why I was so delighted to see innovation come from entrepreneurs in the form of online lending. Mm-hmm. Now, there's lots of evolution in that marketplace, but initially one of the things you could say is that there was a gap. There is a gap. It was not clear that traditional lenders with their cost structure were going to be able to fill it, and that this is the area, as you pointed out, that most small businesses want. They want a loan under, say, $250,000, and many of them want a loan under $50,000. So having a different model with a lower cost structure, a more automated front end, a fast turnaround was really a welcome innovation for small business owners. That said, it remains to be seen in terms of the market evolution how this is going to play out. But on the whole, filling a gap in the small dollar loans using technology is a positive. Mm-hmm,
mm-hmm. And in the paper that you referenced earlier about in your Harvard paper, you talked about the state of small business lending, and it was it's a very really detailed paper. And there you said that the technology is one of the ways that the small business lending problem is going to be resolved. But the thing that and you've talked with a lot of bankers in your time. Why? The question that I'm not sure obviously the cost structures of banks are, that there's a lot of legacy cost structures from the branch network and what have you. But why won't banks adapt and do underwriting in a similar way to the online lending platforms?
Well, there's a number of ways that banks are now entering the game. One way is that some of the larger banks are looking to just plain reduce their turnaround times. And that is a real positive. Small businesses are getting loans the same way they did, 30, 50, maybe even 100 years ago. They walk into the bank, they create a mountain of paperwork, they leave it with the banker, they come back, weeks, sometimes even months later, maybe they get rejected, maybe they get a loan. And that whole process is too long for the small business owner. So the CEO of one of the major banks told me within the last month that they have completely revised their turnaround times. And their objective is to get things turned around in, days and weeks, as opposed to weeks and months. That is all to the benefit of small business owners. Some banks are changing their credit models to look at more automation. Others are saying, I would rather partner with one of the new entrants. And if I want loans on my book, I can buy those loans from one of the online platforms and get my exposure to small loans that way. So there's a whole range of reactions from banks, and I think we are only at the beginning of this story, and we will see it play out over the next 6 to 8 to 12 months, and maybe even over the next several years.
Mm-hmm. Mm-hmm. That's certainly, I think, there's going to be a combination. There'll be some banks partnering. There'll be some banks that will innovate. I expect that's
right.
good to
But
hear.
they're all waking up.
Yes.
They're all waking up and taking notice.
Which is a good thing.
Good thing.
It's a good thing for a small business. It's a good thing for the economy as a whole. I mean,
it's a good thing for the banks because maybe they'll find a way to access this market that they couldn't before, and they'll be able to help in their communities, and they'll be able to help borrowers that they were turning away. And when those borrowers grow to want a larger loan, they'll have a relationship with them.
Mm-hmm. Mm-hmm. So one thing that's also been on my mind, and you're less than 2 years out from your SBA job, wondering, would the SBA ever consider, working with the online lenders or some of the more established lenders, non-bank alternative lenders, whatever you want to call them, in creating like a guarantee program like there is with the banks? Or is there some sort of regulatory hurdle or just structural hurdle that will prevent that? Because it seems like that would be a great thing to help. You look at the small businesses that all want sub 250K loans. Well, I know, it seems like the online lenders could really help small businesses, because all small business owners want a government-backed loan, or the banks want, the lenders would be much more readily available, make their funds more readily available if they know if they know there's a government guarantee. So, what is that something you ever looked at, or is that even a possibility?
Well, even back when I was running the SBA was a leader in looking at small loan processing. And we did something called Small Loan Advantage, where we actually automated quite a bit of the process of getting loans in the smaller amounts. And that trend, I think the openness to that trend continues. The SBA is governed by the existing regulations, but as different kinds of authorized lenders go out and enable, small businesses to get loans and have good track records, I think there is certainly an openness among the legislators that I've spoken with to make sure that SBA continues to be able to provide support for the underserved markets, for those places where you need extra credit support. One of the things I think that I'm very pleased that happened to the SBA in my tenure is that people really understood why it was important to have an agency ready to support a gap when the marketplace failed. We had a real failure in the marketplace in the credit crisis. Good businesses couldn't get loans. And even in good days, there are pockets, underserved pockets, where women and minority-owned businesses have much more trouble accessing capital, but they're great businesses. And one of the reasons we know is that the SBA did these $30 billion worth of lending, and the loss rate was under 5%. So these are good loans out there, and we need all of those entrepreneurs to have access to capital so they can do what they do best, which is create jobs and grow the economy.
Yeah, that makes sense to me. So I wanted to just switch gears a little bit and talk about, the online lending industry per se, which really has been around for a while. It was around before you started at the SBA, and companies like OnDeck, I think it's like 2007 they started. I mean, obviously Lending Club and Prosper have been around for a while. Can Capital's been around longer than anybody. Were these companies on your radar while you're at the SBA?
Well, I had conversations with several of them as early as 2010, I believe, because we did a number of forums on innovation, and they were engaged with us, telling us about what they were doing, talking to us about how we could sort of try to innovate in the marketplace for small dollar loans. So we have had I've had a long history of watching them grow. But I will say that even 2.5 years ago, the industry was in a really nascent stage. When we wrote the paper last year, it was just beginning to emerge with some structure. And as you know, at Lendit, this past year, it just exploded in terms of vibrancy and interest and capital. And I think one of the things that made the change is that institutional capital has found this market. In the early days, players had very, very little capital to offer in their lending portfolios, and they had very, very high cost to access that capital. In the last year, institutional money has come in the form of hedge funds and other folks looking for yield, and that money, if it stays available, creates quite a bit of energy and excitement around the industry and really has changed its profile.
Yeah, no, there's no question that, when we had our first lender, which was, in 2013, that, all of our small business lenders at the platforms, they were all like 6 months old or less, pretty much. It was amazing how young they all were, and not all of them made it, but, and some of them will continue to struggle. But there's a lot of entrepreneurial energy in this industry because, let's face it, everyone in small business, everyone wants to help small business. It seems like it's one of the few, bipartisan, issues that, people believe that small businesses should have more access to capital and everyone wants to help them. So I can...
Well, on that point, I will say that that's one of the things I'm the most pleased about, because I don't think that small business was viewed as a bipartisan issue until my time in the administration. And I give the President Obama, a lot of credit because he had the backs of small business owners from day one. Mm-hmm. And that's one of the reasons I was able to be as effective as I was. And he clearly made this a bipartisan issue, and we were able to get the small business legislation passed that made some of the most important changes in over 10 years. And this now, I think, now it's understood that small business is an engine of growth in the economy. But when I began, I had a lot of convincing to do on Capitol Hill and everywhere in order to make sure people understood the facts, that half the people who work in this country own and work for small business, and they really are the critical piece of creating new jobs. Mm-hmm.
Mm-hmm. Yeah, I didn't realize that's a relatively recent development. Interesting. But anyway, I want to talk about regulation because, this has been talked about a lot. There's really no federal regulator that is overseeing the small business lending industry when it comes to online lenders. And, people talk about, well, there's, these platforms, they have a regulatory arbitrage advantage because of that. What I'd like your opinion on is if you were in charge of regulating this new industry, keeping in mind that there's a lot of innovation happening, how would you regulate it? What changes would you make from the existing structure?
I'm having a number of conversations in these weeks and months with existing regulators to discuss this issue. What should be the regulatory framework for this new segment of the market? And the core idea that I think is important is transparency. Small business owners need to know how much they are paying. They need to understand the terms and conditions. And they need to have visibility into the different options in some kind of comparable basis. It turns out that many in the industry feel that this is also important and will give them, in fact, competitive advantage and help the industry grow. And there's a movement in the industry for self-regulation, for even what they call a borrower's bill of rights. That is a very important activity because at the moment, there is no regulator stepping up and saying, this is my area to regulate. I've spoken with the Fed, the CFPB, many of the other folks, and at this time, there's no concrete regulatory framework being discussed. But this could change quickly particularly if there are some bad actors and small businesses end up paying the price. So I think a move for industry self-regulation and an effort for transparency in a form that business owners can quickly and easily access and understand, those would be major pluses in whatever regulatory environment comes forward.
Okay, yeah, that makes sense. And I know that your partner on your paper, Braden McCarthy, he was on this podcast a few months ago, and he's very, very focused on this borrower bill of rights and transparency. And I think that's one of the things that came up, and I think you even mentioned it in your presentation, is that it's one of the biggest challenges, you say, is that small business owners are not finance experts typically. They're expert in whatever their particular niche is, but it's whether you go for there's so many options for a small business, and one of the things you say it's holding back the industry even is the fact that it's not clear what the best decision is, what is going to be the right form of financing for a business. I mean, is that, do you think that this needs to be part of this kind of transparency, that small business, it needs to be sort of a uniform way of presenting this information to a small business owner?
Well, we started this program talking about my history as an owner and operator of small businesses of all types. And I can tell you from experience that it is very difficult for a small business owner to know exactly what type of loan is right for them. I visited small business owners all across the country every week for 5 years, listening to their stories about why they needed access to capital. And it is something that a small business owner doesn't always have visibility into. When a small business owner wants to grow or wants capital, they have to think very carefully about how much cash do they need and what are they going to do with it, and how is that going to generate enough future profits to pay both the interest and the principal on that loan. How long do they need the money for? Is it going to be to buy a piece of equipment that should pay off over 2 or 3 or 5 years? Well, then maybe they need a term loan. Is it to buy inventory that they're going to sell at Christmas or the holiday season? Maybe they need a 6-month working capital line. So a small business owner needs some help thinking through their cash needs. This used to be the role of the in-person banker. An online lender has to think very carefully about how it is they are going to help small business owners get to the right loan for them. If they get a loan that's too expensive or too short, it is quite possible that they won't be able to handle that loan as well as they would if they had the right loan for them. And that's a bad outcome for the lender as well, because what's going to really happen is that the default rates will differentiate what the costs are for the different players. And those who are better able to get a small business owner into the right kind of product are going to have a better outcome.
Mm-hmm. Right. And so, and what you're saying is that this really should be, part of the self-regulation of the industry in a way where, we have, like in the UK, they have, the Peer-to-Peer Finance Association. Now they have both small business and consumer in that association. But, I've heard a lot of talk, and Sam Hodges from Funding Circle has talked about it in front of Congress, where there's, we need to have a self-regulatory body that really, polices all of the players or the main players in the industry. Now, is that sort of, I guess, if we're talking about, lobbying or even, providing a unified force towards the regulators. I mean, it's pretty. I mean, this is sort of a no-brainer, wouldn't you say, that we have to have some sort of association?
The industry players that I have spoken to appear to be quite interested in being open and forming this kind of association for a whole set of reasons, which are positive. I think in addition, though, individually in their own activities, there's lots of room for some of the different online companies to improve their transparency and to improve the way they help small business borrowers understand the product that's right for them. As I said, I think it will help them get better credits, and it will really differentiate the winners and losers in the competitive game if they can find a way to engage with small businesses in a low-cost online manner that actually helps the small business make better decisions. So that would be a winning strategy.
Sure. No, it's like when we take out a loan, a consumer loan, we have this truth in lending statement that is mandated by the regulators, but there is no equivalent of that with a small business loan. And I think that's maybe because there isn't, we need to come up with our own, and maybe the industry can, maybe companies themselves can start doing it. But I think having a uniform approach, because every one of these, it's challenging because there's different kinds of companies and different kinds of products as far as loan products go. And so, I mean, we have a long way to go there. I totally agree with that. And I hope that we do get some movement on that. And I've heard a lot of people talking about an industry association happening, this year even. So that would be good. But before I let you go, I want to ask one last question about the industry and the future. And we had Larry Summers at Lender just before your presentation say that 70% of non-bank guaranteed small business loans could easily end up in the online lending sector. I mean, would you subscribe to that statement, or are you more bullish or less bullish than Larry Summers?
I think that there's no question that online lending is filling a gap in the marketplace, and it has some advantages that will cause banks to likely partner with them and imitate them in order to create really products and services that have much quicker turnaround and much more cost-effective, costs than a traditional bank underwritten loan. That said, I think that there are some things that we need to be a little bit thoughtful about when we look at how the growth of this market. And that is that small businesses are very, very different. A lot of heterogeneity in the marketplace. Every single one has a different kind of outcome. And the algorithms that we are using now to sort of test creditworthiness are in very early stages. They haven't gone through recessions. They haven't really found exactly the secret sauce to differentiate good credits from bad credits. There's a lot of innovation going on in these algorithms. I think it's fascinating and positive. But until we get that right, it's hard to see, the online lending not having a bumpy road. So it will rise. It might have a bump, and then it might lose access to some of the pools of capital. Then it might rise again because it's fulfilling an important need, and the algorithms get better. So I foresee I'm actually pretty good at looking around the corner. And like everything that involves a small business, it's never a straight line. But I think that overall the trajectory will be that this will be here to stay, and that it will be an important component of small business lending. I believe that we are at early stages of the game, and we have yet to see the full evolution of the partnerships and the players in the industry. So I think the best is yet to come, and overall, I think it will be to the good of small business owners.
Okay, great. Well, on that note, I think we will leave it. I really appreciate your time today, Karen.
Thank you so much. I enjoyed it.
Okay, thank you. That piece that Karen was talking about transparency and about having small business owners really understand what they're getting in for, I feel strongly about that. I think it really should be the cornerstone of what we're doing, what the platform should be doing it. Certainly any trade association that forms sounds like will make it a very important part of being in that group. And to me, it's just the right way to do business, because we want to be able to make sure that every single transaction is a win-win. We want this to be a win for the small business and a win for the platform. Now, some of the time, I think with particularly some of these high interest advances that companies take out, sometimes it's a win because it's just filling a short-term need. And other times it's not a win. And other times the small business owner just doesn't really understand their different options. So I think anything we can do to make this more standardized and help the borrower make a more informed decision, I think can only be a good thing. Anyway, on that note, I will sign off. I very much appreciate you listening, and we will catch you next time. Bye.